Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial secrets that even seasoned execs try to hide. Get ready for a wild ride as we dive into Armada Acquisition Corp. This latest report. It's a real page-turner, folks, with big plans and some even bigger numbers. Before we jump in, if you love getting the real story behind corporate filings, do us a favor and hit that subscribe button. And hey, we've got a fantastic community over on Discord sharing insights, linked in the description below. Come hang out. So, what is the big deal with this report? Well, it looks like Armada Acquisition Corp, Ken,
or a CU as it is known on the stock market, is gearing up for a major business combination. Basically a fancy word for a merger. They're teaming up with Evernorth Holdings Incorporated and Pathfinder Digital Assets LLC, along with a few other players. This isn't just any merger though. It involves Ripple Labs Inc.
And if you are into digital assets, you know that is a name that gets attention.
This report is dated the 19th of October, 2025, and it lays out the groundwork for what they're calling a business combination agreement. Think of it as the official promise to get married. They're aiming to become a single publicly traded company. Now, let's talk about what's being traded here. You've got units, which are basically a package deal, 1 share of their Class A ordinary stock plus half a warrant to buy more stock later. Then there are the individual Class A ordinary shares themselves, trading under the ticker AC. They also have warrants, which are like options, giving you the right to buy stock at a set price, which in this case is $11.5
per share. All of this is happening on the NASDAQ Stock Market LLC.
It's also worth noting that this company is an emerging growth company. This means they get to use some streamlined rules when reporting to the SEC, which can make things a bit less burdensome for them, but potentially less detailed for us. They have elected to use the extended transition period for complying with new or revised financial accounting standards.
The core of this filing revolves around a significant agreement, a business combination agreement signed on the 19th of October, 2025. It brings together Armada Acquisition Corp, the second, which will change its name and structure as part of this deal, with Evernorth Holdings Incorporated and Pathfinder Digital Assets LLC.
The deal also involves a couple of subsidiary companies set up specifically for this merger. Evernorth Corporate Merger Sub Incorporated and Evernorth Company Merger Sub LLC. And, of course, Ripple Labs Incorporated is a key player here too.
So, what exactly is this business combination agreement? It's the rulebook for how these companies will merge. The goal is to combine everything by a certain date, the closing date. In essence, one of the subsidiary companies, Company Merger Sub, will merge into Pathfinder Digital Assets, making Pathfinder the surviving entity.
Holders of Pathfinder's units will then get shares in the new public company, called PubCo. Simultaneously, another subsidiary, SPAC Merger Sub, will merge into Armada Acquisition Corp, Tekken itself, with Armada continuing as the survivor.
This SPAC merger is crucial because it means the shareholders of Armada Acquisition Corp, the SEC, or SPAC as it is called here, will get shares in the new combined company, PubCo. And the people holding Armada's warrants will get warrants for the new PubCo stock. The whole point? PubCo will become the publicly traded entity after all these mergers and transactions are done.
Now, let's get into the nitty-gritty of the new company's stock. PubCo will have 3 classes of stock. The Class A common stock is the one that will be traded on exchanges like NASDAQ. It comes with economic rights, meaning you get a piece of the company's profits if they distribute them. And each share gets 1 vote.
Then there is Class B common stock, which also has voting rights but no economic ones. These Class B shares won't even be issued right away. Finally, the Class C common stock has economic rights but limited voting power, and it can be converted into Class A stock.
This structure gives the company flexibility, but can also be a bit complicated for investors to fully untangle.
Before all this merging happens, Armada Acquisition Corp, the second, which is currently registered in the Cayman Islands, is going to legally move its headquarters to Delaware. This is called a domestication. Think of it as changing your company's home address to a different state or country. This means they'll file new incorporation documents in Delaware,
called a charter, which will lay out exactly how the domesticated company, called Domesticated SPAC, will operate.
As part of this domestication, all the existing Class A ordinary shares of Armada will become Class A common stock in the Delaware company. The Class B ordinary shares will similarly become Class B common stock, and the warrants will convert into warrants for the new company.
Even those unit bundles will convert into units of the domesticated SPAC.
Still, including a share and half a warrant. It is essentially a legal house cleaning to prepare for the big merger.
The agreement also includes representations and warranties. These are essentially promises each company makes to the others about the state of their business. They're like the "this is what I promise to be true" part of the contract. They cover things like the accuracy of financial information and the authority to enter into the deal.
Most of these promises don't last past the closing of the deal, except for a few.
And what happens if something goes really wrong? The agreement defines a material adverse effect. This is a big deal, meaning something that seriously damages the business, its operations, or its ability to complete the merger. Importantly, general market changes or big global events usually don't count unless they hit a specific company much harder than everyone else.
Even changes in the price of XRP aren't automatically considered a material adverse effect. This definition is key because it can be an exit ramp for the deal if things go south.
Then we have the conduct agreements called covenants. Before the deal closes, both sides have to act in good faith, running their businesses as usual. They can't make major changes or enter into competing deals without getting agreement from the other parties. It is all about keeping things stable and predictable while the merger is being finalized. They also have to use their best efforts to make the deal happen, including the complex steps related to XRP. Speaking of XRP, the companies have agreed that within 10 days of signing this agreement, the company will actually buy a bunch of XRP tokens. The amount they buy will be based on the cash raised from something called advance funding. This XRP will be held in a digital wallet for the company. It shows just how central XRP is to this entire transaction. To get this deal approved by regulators and shareholders, they need to file a registration statement with the U.S. Securities and Exchange Commission, or the CC. This document will contain a lot of important information, acting as both a prospectus for new investors and a proxy statement for Armada shareholders who need to vote on the deal. It is a really detailed look at the proposed combination. The shares planned for issuance as part of this deal will be registered under the Securities Act of 1933. This is the law that governs how companies sell securities to the public, making sure investors have enough information to make informed decisions.
Now, for a business deal like this to actually happen, there are a bunch of conditions that need to be met. Think of them as hurdles they all have to jump over. First, Armada's shareholders need to vote yes on the deal. Then, any government approvals, like from the HSR Act, need to be secured.
The new company's shares need to be approved for listing on an exchange like NASDAQ. And importantly, Armada needs to have at least a certain amount of cash left after all is said and done, specifically more than $5 million. There are also conditions specific to Armada needing the other parties to hold up their end of the bargain. Their promises about their business need to be true. They need to act properly before closing.
And, critically, no material adverse effect should have occurred with their businesses. On the other side, the company, Pubco, and the merger subs have their own set of conditions regarding Armada's promises and actions. They also need to make sure that the sponsor, which is likely a key early investor or group,
has fulfilled their obligations. And the investors who are contributing either cash or XRP for these deals need to come through.
What if things go sideways? The agreement has termination clauses. Either side can call it quits if the deal isn't closed by a certain date, called the outside date, which is a year from signing. But you can't walk away if it is your fault that the deal is delayed. Also, if a government regulator permanently blocks the deal, that is grounds for termination.
And if one party seriously messes up and doesn't fix it, the other can walk. Even if Armada's shareholders don't approve the deal, either party can terminate. Interestingly, nobody has to pay a termination fee or reimburse the other for expenses if the deal is called off. However, they are still liable for any intentional breaches or fraud. There is a catch. Both the company and Armada will split the costs associated with filing the SEC registration statement and the NASDAQ listing application. So, they both have a vested interest in managing those specific costs. A crucial point here is that the other companies involved are agreeing not to touch the money held in Armada's trust account for its public shareholders. They're essentially waiving any claims to that money, which is standard practice for these types of SPAC deals. This ensures that the funds meant for public shareholders are protected.
Moving on, there is also an amended and restated registration rights agreement. This document essentially gives certain shareholders the right to have their shares registered, and thus be able to sell them on the public market. It will apply to the new Pubco stock, and it supersedes any existing registration rights agreements Armada had.
It includes standard provisions for things like demand registrations, where shareholders can force the company to register their shares, and piggyback registrations, where they can join in on other registrations.
Then we have the sponsor support agreement. This is where the sponsor, likely a founding group of investors, agrees to vote in favor of the deal. They're also agreeing to abide by certain transfer restrictions on their shares, and not to redeem them in a way that might hurt the deal.
They are also agreeing to forfeit a significant number of shares and warrants 120,000 Class A shares, 2.3 million Class B shares, and 60,000 private placement warrants. This is a substantial reduction in their holdings before the merger, likely to help meet certain financial conditions for the deal. The sponsor is also releasing claims against the companies involved.
Following the deal, key players, including the sponsor, Ripple, and certain Ripple investors, will sign lockup agreements. This means they can't sell their shares of Pubco stock for a period, typically 6 months after the deal closes. This is designed to provide stability to the stock price right after the company goes public and prevent a flood of shares hitting the market too soon.
Now, let's talk about how they're funding this. There are several subscription agreements. The advanced funding subscription agreements involve investors putting in cash and XRP tokens for shares of Pubco Class A common stock. The total cash raised here is a massive $214.05 million plus 600,000 XRP tokens. The price for these shares involves something called the signing date XRP token VWAP, which is the volume-weighted average price of XRP on a specific benchmark, called the CME/CF XRP dollar reference rate, on the day before the agreement was signed. This shows how closely tied the share price is to XRP's value. They even have adjustment shares,
Meaning the number of shares investors get can change based on the XRP price at the closing date. If XRP's price goes up, they might get fewer shares, and if it goes down, they might get more, up to a certain point. This is a sophisticated way to manage price risk.
There are also delayed funding subscription agreements, where investors are contributing $10.5 million in cash and 200,000 XRP tokens. The pricing here also relies on the XRP value, but in this case, the number of shares received is directly tied to the closing date XRP token, VWAP.
Meaning the final share count will be determined by XRP's price at closing. And then there is a Series C subscription agreement with the sponsor. This is a bit unique, as it involves a massive contribution of over 211 million XRP tokens. The sponsor will receive a mix of Pubco Class A and Class C common stock.
The number of Class A shares they get is designed to ensure that certain Series CDQ persons collectively own no more than 19.9% of Pubco's capital stock immediately after the closing. This sounds like a mechanism to control ownership percentages. They will receive Class C shares for the rest of their subscription.
The Ripple Group subscription agreements involve affiliates of Ripple contributing 50 million XRP tokens. They will receive a mix of Pubco Class A common stock and company units. The goal here is to ensure that Ripple Group holders collectively own no more than 9.9% of Pubco's capital stock.
Crucially, for all these subscription agreements, no fractional shares or units will be issued. Any fractions will be rounded down. Pubco also promises to file registration statements to allow these subscribers to resell their shares within a specific time frame after the closing.
There is also a tax receivable agreement. This is a common feature in these types of deals. Pubco will agree to pay the other parties, the TRA parties, 85% of the tax savings that Pubco gets as a result of the increased tax basis and assets created by the transactions. Essentially, when the companies combine and assets get a step
up in tax basis, Pubco gets tax benefits, and these agreements allow the original owners to share in a portion of those savings.
Now, let's look at some potentially key financial figures.
As of the 30th of September, 2025, Armada Acquisition Corp. The second had approximately $234.6 million in cash and marketable securities held in its trust account. This is a critical number because it represents the funds available to the company before any merger. It's important to remember that this is a preliminary,
Unaudited amount and could change. Also, this figure doesn't give us the full picture of their financial health.
The report also mentions the private placement transactions that will occur. These are the sales of securities that, as noted, won't be registered under the Securities Act.
This is happening under exemptions like Regulation D, commonly used for private sales to institutional investors and accredited individuals who are assumed to be sophisticated enough to understand the risks without the full public registration process.
This section tells us that the company is releasing an investor presentation and a press release related to this announcement. These are important for general disclosure, ensuring that all investors have access to the same information. Investor presentation and press release, dated October 2025. The investor presentation, dated October 2025,
and the press release dated the 20th of October 2025 are key. They're designed to communicate the excitement and strategic rationale of this merger to the market, likely highlighting potential growth and the benefits of combining these entities, especially with Ripple Labs' involvement.
This part of the filing discusses a contribution agreement.
Here, Ripple Labs Inc. is agreeing to contribute a substantial amount of XRP tokens, over 126 million XRP, to Pathfinder Digital Assets in exchange for company units. These units will then be converted into shares of PubCo class, a common stock, at the merger's closing.
This is a direct and significant injection of XRP into the operational structure of the new company.
The filing also includes a section with the standard legal disclaimer about where to find more information, like the upcoming S-4 registration statement. They emphasize that this report is for information only, and not a solicitation to buy or sell securities. It's a reminder to investors to do their own research and read all the official documents before making any decisions.
This is a critical legal statement. It clearly states that neither the C-Key nor any state regulatory body has approved or disapproved this deal. They are not vouching for its fairness or the accuracy of the information.
This is a standard but very important disclaimer that underscores the responsibility of investors to make their own judgments.
And finally, we get to the forward-looking statements. This is where the companies talk about their hopes and expectations for the future. They mention things like anticipated benefits, expected trading on NASDAQ, the completion of investments, and their vision of building an institutional XRP treasury. These statements often use words like anticipate, believe,
expect, and plan. While they paint an optimistic picture, they come with a whole host of risks.
Some of the biggest risks highlighted here relate directly to XRP. The report explicitly mentions the volatility of XRP's price and how that volatility can directly impact the value of PubCo's securities. This is a huge red flag and a major risk factor. They are essentially warning that if XRP's price tanks,
the value of the company's stock could plummet too, even if the company itself is doing well operationally. They also point out the risk of XRP price drops occurring between the signing of the deal and the final closing, or at any point afterward. This dependence on the price of a single digital asset is a significant point of concern. Overall,
this filing signals a massive strategic pivot for Armada Acquisition Corp. 2. Moving from a typical SPAC shell company to what appears to be a vehicle focused on digital assets, specifically XRP, with Ripple Labs Inc. at its core.
The structure involves significant capital raises through both cash and XRP contributions, indicative of a strong belief in the XRP ecosystem. However, the heavy reliance on XRP's price introduces a substantial layer of speculative risk. The success of this venture will likely be inextricably linked to the future performance and regulatory landscape of XRP. All right, that is our deep dive into Armada Acquisition Corp. T's latest filing. What do you think about this XRP-centric merger?
Does the reliance on XRP's price seem like a calculated risk or a recipe for disaster? Let us know your thoughts in the comments below. If this breakdown was helpful, please give this video a thumbs up and subscribe for more corporate decoding. And don't forget to join us on Discord. The link is in the description, a great place to connect with other savvy investors.
Thanks for watching, and we'll see you in the next one.